a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about buffered ETFs or defined outcome ETFs that provide protections against market downside. And in particular, we will focus on 100% loss protection ETFs that are becoming quite popular with investors. So the market has been quite volatile lately. And yesterday, in particular, after an unexpectedly weak July jobs report that we got on Friday, market had a major sell-off yesterday because of rising fears of a hard landing. And with rising macroeconomic uncertainty as well as political uncertainty, because we have a presidential election coming up. So market could remain volatile in the coming months. So that is why these buffer ETFs or defined outcome ETFs that participate in the market upside up to a cap only. So market upside is capped, but they provide protection against losses. They are becoming increasingly popular. And this is one of the fastest growing ETF categories, particularly after stocks and bonds had a terrible performance in 2022. Investors have poured a lot of money into these protection ETFs. These now have about 45 billion in assets. And also there's rising interest in these ETFs because the upside potential that you get, these caps are at highest levels in 20 years. That is according to Innovator, which is a pioneer in this space. And with the Fed said to start cutting rates probably in September, if not earlier, then probably it makes sense to lock into those levels of upside potential currently. Now, this was the first ETF by Innovator, T-Jul, which launched last year, and this provided S&P 500's return up to a cap of 16.62% over a period of 2 years, and that this was the outcome period. Investors did forego dividend income. This has an expense ratio of 79 basis points and more than 253 million in assets. If you want to learn more about this ETF, you can go to the quote page on Zacks.com, and using the link, you can go to Innovator's webpage for this ETF. I have done podcasts with Innovator on this issue and also with Calamos. So you can listen to the podcast and learn more about these products. Now, in general, when you are looking at these buffer ETFs, these are the variables you should take into account. So what is the reference asset? Most of these ETFs, for them, the reference asset is S&P 500 index, but we have seen a lot of other reference assets too. For example, I mentioned Calamos. So as an example, let's go to Calamos webpage for these ETFs, buffers ETFs, and Calamos calls them structured protection ETFs. So every month they roll out new products, and each month the reference asset is either the S&P 500 ETF or the Nasdaq 100 ETF or the Russell 2000 small cap ETF. So in September, they will be launching a new product which will have the Nasdaq 100 ETF as the reference asset. The second variable that you should always remember is what is the downside buffer you are looking at. So there are different kind of buffers. Let's take an example from iShares webpage for this ETF. So today in particular, we are talking about ETFs that provide 100% loss protection, and the iShares product is Max J for 100% loss protection. But they also provide other buffer strategies. For example, if you want to consider moderate buffer, which will provide protection against first 5% of losses, or deep buffer, which will provide protection against 5 to 20% of market losses. Then upside cap. So let's take a look at some examples and also the outcome period. Remember the cap and buffer that you are getting, that is only for the outcome period. So if you buy the product on the first day and hold it for the entire outcome period, in between, if you buy, your outcome may be slightly different, and the provider will provide you details on the expected outcome if you buy in between. So again, let's take an example. This is, let's take a look at innovative products. So they have outcome periods of 6 months, 1 year, and 2 years. Now, so JAJL is the product which has an outcome period of 6 months. So if you are particularly worried about election-related uncertainty, then you should look at this product, and this has a cap of 5%. If you want to lock in for a period of 1 year, then the product is JAUG, and the cap is 8.82%. For a period of 2 years, if you want to lock in at these attractive levels of caps for a period of 2 years, then the product is AGUL. Now, just to understand a little bit more how these caps and buffers work. So if the market has 100% loss, so for example, the S&P 500 falls 100%, just a hypothetical scenario, you suffer no losses. If the S&P 500 falls 30%, you suffer no losses. You're protected against all losses. If the S&P 500 rises 8.82%, your outcome is 8.82%, which is the cap. If the S&P 500 rises beyond that, for example, if the S&P 500 rises 15%, your upside will be capped at 8.82% in case of 1 year outcome period. Now, you should also look at the expense ratio. In general, these products are expensive. They charge between around 50 basis points to 80 basis points. And iShares products are the cheapest. I had mentioned Max J. This has an expense ratio of 50 basis points, and this is the cheapest product in this space. iShares products are the cheapest. Innovator, Calamos, and First Trust, their expense ratios are slightly higher. Now, how do these products work? These use flexible or flex exchange options. And in general, what they do is they buy deep in the money call options to get exposure to the reference asset. It could be S&P 500 exposure or any other index exposure, as I mentioned. In case of iShares products, iShares holds their own S&P 500 ETF, which is IVV, to gain exposure to that particular ETF. Then what they do is that they buy put options, which provides 100% downside protection at the money put option. And then they sell call options, because this is expensive to So to reduce their expenses, these products sell call options, which in turn limits upside returns. So in fact, if you go to Tjul website, web page that I had mentioned, you can see that it has these options: call options, put options, and sold call options. And this combination will provide you the desired outcome. And I had mentioned iShares. So they actually hold their own S&P 500 to get exposure to the S&P 500 indexes outcome. Now, should you get downside protection? So, as I mentioned, these products are expensive. And in general, investors should remember that stocks go up over the long period. And if you're a long term focused investor, you should just ignore the short term noise, whatever happens in the market over the short term. So, yesterday stocks were down, today they are up. But if you are a risk averse investor, particularly in retirement or nearing retirement, so these kind of products then make a lot of sense. And we know that there's a lot of money on the sidelines, more than $6 trillion in money market assets and other cash like instruments. And investors have been skeptical of stocks because of particularly after terrible returns in 2022. So for those investors, these kind of products make a lot of sense. And for long-term investors, I had mentioned stocks go up, and the S&P 500 ETF, since its inception about 30 years back, it has produced an average annualized return of about 10%. So you can just ignore and hold it over the long term. But for risk averse investors, these buffer ETFs make a lot of sense. And many of these risk averse investors who are in retirement or nearing retirement, they have been buying products like index annuities or market linked CDs that provide protection against market losses. Compared to these products, annuities and series, ETFs are much better because of these reasons. They have much better tax efficiency. They are much cheaper. As I mentioned, you have iShares products available at just 50 basis points expense ratio. There is no minimum purchase size. There's liquidity and daily pricing that you can see in these products. And further, there is no credit risk. When you are buying annuities or CDs, you always have a counterparty credit risk. So for such investors, ETFs are much better and worth a look. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. And also make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.